Welcome to the Daily Brief, where I'll go over the action in the market for Monday, December 5th, and then we'll see how things are looking for Tuesday, December 6th. And first of all, I apologize for posting this a little bit later than usual. Some of you like to watch this right after I upload it. I had a scheduling conflict that I wasn't aware of, and so I'm a little bit late recording and posting this. All right, now let's talk about the day. We had a down day. Things are still positive, but we're kind of getting close to that tipping point because we're seeing some weakness right now. And there's a couple of charts that I want to spend a little bit of extra time going through. We have worked off this short-term overbought condition. Yeah, you go down almost 2%, that's going to happen. And the intermediate term has worked off. So we're no longer considered to be overbought in any of the time frames. But if we don't show some buying coming back in pretty quickly, we're in danger of losing this. So let's go back and talk about some things here. Right at the open, we had a gap lower open, and we really declined right after the open. We went below S1 at 40.39. And then once we got below that, S1 acted as resistance. We tried to come back up, but we kept bumping into that. As the day went on, prices fell to S2 at 40.06. So we're right back around that 4,000 level now. We did drop below 4,000, and then we closed just a little bit below 4,000. So we came back up. We were slightly off the low. In the day, we were down 1.79%. We were down over 2% at one point on below average volume. It did increase from Friday's pace, but we're still below average overall. The technicals, as I said, they're hanging in there positive, and we have some positive backdrops. We also have some things that are concerning that I'm going to go through. And if you've watched these videos for very long, when we're going up, I tend to focus on, okay, what can make us go down? When we're going down, I tend to focus on, okay, what could help us to go up from here? Inflation and interest rates are still the big concern, the big fixation for the markets, but we have the whole list of geopolitical concerns, earnings as they're coming out, and then any Fed speak that we may get. And that was kind of a trigger in Monday's session, was through the Wall Street Journal, there was another article that came out. So here is the intraday chart. Each one of these bars is 10 minutes. We gapped lower. We quickly went down below S1. And then you can see here, we tried to come back up to S1, but it acted as resistance. We fell from there all the way down to S2, which for a while provided support. But then we went through that. We ended up setting the low not too long before the close, but then we came back up slightly. So we're just a little bit below 4,000 currently. What are some comments? We fell below the 200-day simple moving average. That is not positive. We've been able to stay above that for right now, and we fell below the 4,000 level. The dollar was up and interest rates rose. So that was some of the headwinds that stocks ran into. And then this is the Wall Street Journal article. And if you remember a few weeks back, this is the reporter that the Fed seems to like. So if they want to like just send something out as a trial balloon, they might send it out to this guy through a Wall Street Journal article, Nick Chamerios, or however you say his name. In this article, he basically said that wage inflation, this is back to the employment situation now, because if people are having, or if companies are having a hard time finding people to work, well, maybe they'll have to entice them by paying them more. And that's what we call wage inflation. And this could set the Fed's terminal rate or benchmark rate higher than 5% in 2023. So that's kind of the concern right now. The market had been pretty much thinking that we're going to top out at about 5%. This article says, well, if the employment situation stays pretty strong, the Fed may even have to go above that. And then China appears to be relaxing their COVID restrictions. And then OPEC came out over the weekend and said they're going to keep cutting production by 2 million barrels per day for the next year through 2023. So that is kind of driving oil prices, or at least for right now, it's driving oil prices down. But over the long haul, that's going to make the amount of oil on the market less. than what we, at least the US, had been hoping for. So that will eventually drive prices back up. The EU and its allies, they agreed to a $60 per barrel price cap on any Russian oil. That could cause some problems. Now, this is the EU, but the US is closely tied to the EU economically, so we'll have to see if there's any fallout from this. And then the VIX with the down day, it's back above 20. That's the static line that we look at, and it's no longer extreme negative. And I'll show you that when we look at our RSI. And we only have one short-term indicator that's still extreme right now, and that's the Stochk RSI. After Friday's session, it was extreme positive. After Monday's decline, it's now extreme negative. That's how touchy this indicator is. It's the only one right now, but it is showing us nonetheless. Then the BPI is still extreme positive, and I want to go through that. I want to spend a little bit of time talking about the BPI. Our yield curves are still inverted, the same ones that we've had before. Sentiment is still positive. It hasn't really moved all that much. We had the ISM non-manufacturing. This came in stronger than expected and added to the good news is bad news scenario. It came in at 56.5. They expected it to come in at 53.5. The last time we got the report, it was at 54.4. So stronger than expected and stronger than last time. And then factory orders, they increased 1% month over month. This was greater than expected at 0.7. That's what they thought. The last time we had this, it was up 0.3. And manufactured goods that were shipped, that increased 0.7% after the last time we saw an increase of 0.3%. So both of these reports by themselves are kind of strong. The final IHS Market Services PMI, or Purchasing Managers Index, it came in at 56.2. The last time was 46.2. The last time was 46.1. Anytime we're below 50, that's the contraction level, but it was still a little bit higher than the last time we had this. Our trend is positive, but with the down day, we've dropped below the moving average. So it's a weakening trend. We're still above 20. Now with this solid down day, I've changed our bias to negative and our momentum still to mixed at this point. All right, then I did find an update of this model chart from 2006 to 2008, and how are things going with that? Instead of green, now we have yellow, and this is what the S&P did back from 2006 to 2008. The white area is updated to show how we have been following that. And if we do stick to this model, right about now is when we would start to see a decline. It's kind of getting close to matching up with this. We will have to see. There are some concerns that I'm going to go through. Here's the VIX chart that I've been going through. I have not found an update to that. The VIX is low, starting to go back up, but we're looking at very, very high levels, which would coincide with a pretty hefty decline if the VIX is to climb to these levels. Then on a one-day basis, we kind of overdid it with the advanced decline ratio just from Friday to Monday. So we went extreme with that. So we might have gone down a little far too fast. Here's the BPI, and we're in extreme positive territory. You see the little tick down? That's positive. You could take some positive things away and some warning signs away from this chart. The fact that we had almost a 2% down day and this barely budged, that's pretty good. But here is where we're getting to a pretty toppy point with the BPI. Now, just to take this a little bit further, this is a longer term chart where when this spikes and starts to come down, a lot of times that marks a top in the S&P. Now, one thing that I did note here is that you notice how we made a top and then we made a lower high with the BPI and a higher high with the S&P. That's a positive divergence, okay? You could also call it, well, I should say a negative divergence, because as we're making higher highs, we want to see the BPI also making a higher high. So I was incorrect. That should be a negative divergence. My notes are right. I just said it incorrectly. But we see a lot of this. And even though we see negative divergences, the S&P still went on to make higher highs. We do have a positive here where the S&P made an all-time high right at the beginning of 2022 and then kept making pretty good highs with the BPI, but we were going down as well. So we're seeing more positive divergence in a bear market. That's a little bit different. For some of us that use a lot of oscillators, we like to look for divergences, either positive or negative, and are they matching what is happening with price? This is telling me that when we're in a bull market, when we're going up, you can kind of ignore the negative divergences. When we're going down, you should be a little more suspicious, not necessarily ignore, but be more suspicious of the positive divergences. And this gives you an idea. When we topped out and started going down, what happened after this? Well, we're close to we may have topped with the BPI now. There's really no set limit to this, to the upside. But at some point, if this really starts to fall, we might see the S&P really start to fall closer to the model of what we're seeing. I'm not saying that's what will happen, but look at what's happened when the BPI was at this level before. We saw at least some kind of a short-term pullback, even in a strong bull market. We saw bigger moves in the bear markets that we've been seeing throughout 2022. And I say markets because I'm still sticking with the idea that we're in a very long-term secular bull market, but what we've been seeing in 2022 is more of a cyclical bear market. Now, other people might disagree with that, but that's okay. All right. The VIX is no longer extreme negative when we look at the VIX with the RSI 9 period, and we're back above 20. Another thing is we're below the moving average with our ADX. We're still above 20. Now, if we continue to fall, this will probably drop. The green line is still on top, so we're defaulting to the positive trend, but it is getting weaker. There's another chart we haven't really looked at. This red line here is a triple exponential moving average. So far, this has acted as pretty good support as we've been going up. And the red line is above the blue line, which is a double exponential moving average. So the triple just shows that we're seeing stronger upward movement right now. So we're looking at how are these moving averages behaving and where is price in relation to that as well. We're still above this anchored moving average going back to the COVID low in March of 2020. The summation index starting to turn down. This is an intermediate term indicator, turning down based on price and volume. That is negative. And then our equity put call ratio, even though it's still really high, it's been coming down. We were down almost 2%, and this is declining. Very strange. Here's our 5-period moving average, still showing that we're at a high level, but we are coming down overall. Here's our daily chart, where we're still, we came right up to this trend line, and we're bouncing back down. Can we get back above what's now a resistance level, and can we get above this trend line? It's going to have to happen if we're going to stay positive. If we break down, especially below this pivot, that's going to look a lot more negative. And then at the bottom, we see the volume did increase from Friday, but it's still below average. And then here's our moving average tree, where we came back down below both of the 200-day moving averages, the exponential and the simple. We're still above the shorter term moving average, which is the 20, and that's pretty good support in the short term, where the 50 is more intermediate term and the 200 is longer term. The new highs, new lows, even though we saw a real decline in the new highs and a little bit of an expansion in the new lows, we're still holding up with our 5-period, but we're pretty much flat with our 10-period differential. The STO, which I showed in yesterday's video, is still declining with the down day. And even when we were really going up strong, the STO was still declining based on price and volume. We've dropped down below the 61.8% retracement at about 40.09 or so, and we're below that. So we're seeing if we drop down to this 50% retracement level, will that support hold? We're still a bit a ways from it, but anything can happen. If we try to come back up out of this 40-10 level may act as overhead resistance. Longer term, we drop down below this thick blue line here, the 50% retracement at about 40.20. If we come back up, that may be more overhead resistance at the 40.20 level. And then on this chart, we're going to go all the way down to the 38.25 or 26 level for support for that. But that's a little further away than where we're at right now. The weekly chart, so far, the weekly bar has dropped back down below the 40-week moving average. That's negative after climbing above it after Friday's session. Can price get back above this moving average? Oil, this is where we've been really seeing a drop. Currently, we were down 3.81%, and we're down at around 76.93. So what's our outlook then for Tuesday? The technicals are positive but weakening. That's kind of the scenario right now that we're going with. We're still trying to ask, has the Fed pivot finally happened? We have the trade balance coming out, not a real biggie as far as how it will impact the market. The whole list of geopolitical events with inflation and interest rates and possible Fed speak, that may really drive the markets right now. But as I always say, any one of these areas can quickly come back in, either positive or negative, and have an impact on the market. So our scenarios, not going with the down scenario, and we're not overbought anymore, but we are showing some weakness. We're still going with the up scenario, even though we're weakening. And our sector rotation, that was pretty much flat. It held up a little better than I thought. Our positive setups, our longer term setups based on 200-day moving averages, those are still advancing because we're above, well, we're not above the 200-day, but we've been above it for a while. So they're still picking that up. Our shorter term setups, yeah, they showed some weakness in Monday's session. So we have to see, can we get back some moving averages, or we're going to lose even more? The pivot levels that we've lost, they may act as support resistance, as will the fib retracement levels potentially. So not going with the sideways, at least trend for right now, because even though we're weakening, the ADX is still above 20, the green line's still on top, but it is weakening. So our conclusion, the S&P is positive, but right now it's showing some weakness. Short-term weakening, we're not overbought any longer. Intermediate term, not really overbought except for the BPI, but it is showing some weakness. Long-term, we're still improving. But if we stay any length of time underneath the 200-day moving average, this improving is going to turn into weakening again. So thank you. Have a wonderful Tuesday. I hope you found this helpful and gave you some insight as to things. And this will be the only video that I post today. So I'll talk to you in the next video tomorrow.